In his annual letter to shareholders, Buffett praised the 5 Japanese firms owned by Berkshire and noted raising his stake in the companies. According to FactSet, since announcing their investments in Mitsubishi, Itochu, Marubeni, Mitsui, and Sumitomo, the returns in yen of those five companies range from a low of 185% to a high of 402%.
In 2020, Warren Buffett made an announcement that surprised global investors, far more than it surprised Japan. He invested in Japan's major general trading houses. Immediately, questions began to surface outside Japan. Why trading houses? What do they actually do? And why would Buffett invest in businesses that most foreign investors struggle to even define? 3 years later, in 2023, Buffett visited Tokyo. During an interview, he said something that quietly answered all of those questions. Referring to Japan's 5 major trading houses, he said, "They are really so much similar to Berkshire Hathaway." That sentence matters. Because Buffett was not talking about stock prices. He was talking about structure, about how money is made, about how businesses endure. Hello, my name is Shosha-man. I am an active employee at one of Japan's major general trading companies, or Sogo Shoshas. I work inside this system, not as an analyst looking from the outside. Today, I want to explain something you will not clearly find in earnings slides or valuation models. I want to explain how Japanese trading houses actually generate money, and why Buffett immediately recognized something familiar in them. To understand today's Japanese trading houses, we need to go back to the 1990s. This was a period of dramatic change for Japan. After the Plaza Accord in 1985, the Japanese yen appreciated rapidly against the US dollar. This was not just a foreign exchange issue. It fundamentally altered the structure of Japan's economy. At that time, Japan was heavily dependent on manufacturing companies. When Japanese people say manufacturers, they usually mean vertically integrated industrial firms. These companies handled research and development, production, and sales, largely by themselves. Automobiles, electronics, machinery. Japan's growth was built on making things. But as the yen strengthened, something critical happened. Producing goods inside Japan became too expensive. Labor costs, real estate costs, and currency strength combined into a single problem. Japanese products became less competitive globally. As a result, many Japanese manufacturers began moving their production overseas. This shift was massive, and it changed everything. For Japanese trading houses, this period was deeply unsettling. Historically, trading houses played a central role in connecting Japan to the world. They sourced raw materials. They arranged shipping. They handled financing, insurance, and settlement. They stood between producers and markets. But as manufacturers expanded globally, they began doing many of these things themselves. They sourced directly. They sold directly. They built their own overseas networks. Inside trading houses, a dangerous question emerged. Are we still necessary? Some people openly said that trading houses were nothing more than middlemen, that they added cost without adding enough value, that the business model itself might disappear. In Japan, this period is often referred to as the winter of the trading companies, a phrase that captured the widespread belief that the traditional trading company model was nearing its end, and it was very real. Faced with this reality, Japanese trading houses made a fundamental decision. They chose not to remain simple intermediaries. Instead, they chose a much harder path. They decided to take risk. They began investing their own capital into businesses, not as short-term financial investors, but as long-term partners. They entered operations. They provided management support. They committed to businesses for decades, not quarters. This was not a cosmetic change. Trading houses began to transform themselves into hybrid organizations, part investor, part operator, fully exposed to real-world business risk. This shift did not happen overnight. It took years, and in some cases, painful failures. But this is the foundation of the trading houses you see today, and this is the starting point of the money engine that Buffett recognized. So, if trading houses are no longer just intermediaries, and not exactly private equity firms either, the next question becomes obvious. How do they decide when to invest? And more importantly, how do they manage risk in businesses they know so deeply? That is what we will explore next. When overseas investors think about investments, they usually imagine conference rooms, PowerPoint slides, Financial models. Management presentations. That is not how most trading house investments begin. In many cases, there is no investment discussion at all in the early stages. Instead, everything starts with very ordinary business: buying and selling materials, arranging transportation, managing inventory, solving daily operational problems. These activities may look simple from the outside, but over time they create something extremely valuable. They create context. In a trading house, daily transactions function as a living due diligence process. This is very different from financial due diligence performed over a few months. When you trade with a company every day, you learn things that never appear in financial statements. You learn how management behaves when margins are under pressure. You see how they respond to unexpected disruptions. You find out whether they protect long-term relationships or chase short-term gains. You observe how cash actually moves through the business. Not how it looks on paper, but how it behaves in reality. Over years and sometimes decades, this accumulation of experience becomes extremely powerful. By the time an investment discussion begins, there are very few surprises left. This is an important point. Trading houses do not start trading with a company because they want to invest. In many cases, there is no investment intention at all in the beginning. Business relationships simply continue, year after year, through good cycles and bad cycles. Then one day the conversation changes. The partner company may face a succession issue. The founding owner may be thinking about the next generation. The business may need a stable shareholder to support long-term growth. At that point, the trading house is no longer a stranger. It is a familiar partner. Someone who understands the business deeply. Someone who has already proven commitment. This is often when investment discussions begin. Even then, trading houses rarely move aggressively at the beginning. The typical process is gradual. First, a small minority investment, often around 5 to 10%. This initial stake does not aim to control. It aims to align interests. If cooperation deepens and trust continues to build, the relationship may evolve into an equity method affiliate. At this stage, the trading house begins to share more responsibility, sometimes through board participation, sometimes through deeper operational involvement. Only when strategic integration becomes necessary does full acquisition or subsidiary status occur. This step-by-step structure is not conservative for the sake of caution. It is designed to match capital commitment with information certainty. From the outside, this approach may look slow, but structurally, it reduces risk in ways that are difficult to replicate. Trading houses do not rely solely on forecasts. They rely on lived experience. They invest after they already understand the business at a granular level. This is why many trading house investments do not feel like bets. They feel more like natural extensions of existing relationships. Another critical difference lies in incentives. For many financial investors, the primary goal is capital gain. For trading houses, capital is a tool. The objective is to build durable business ecosystems. Investment strengthens the relationship. The relationship strengthens the business. And the business generates continuous cash flow. This is the logic that underpins the trading house model. So far, we have talked about how trading houses decide to invest. But that leads to a deeper question. Once the investment is made, how do trading houses actually make money over the long term? Why are they able to generate stable returns even during downturns? To answer that, we need to look at the structure of their profits. That is where the real money engine appears. This is the point where most explanations of trading houses fail. Many overseas investors assume that trading houses make money, the same way other investors do. They invest capital. They receive dividends. They may eventually sell at a profit. That is only half of the story. Japanese trading houses operate with a two-layer profit structure, and this difference changes everything. But what exactly does a two-layer profit structure mean? Is it simply about dividends and equity method income? Or is there another source of cash flow that most investors overlook? This is where Japanese trading houses truly diverge from conventional investors. Even after an investment is made, they do not step back. They stay inside the business. They continue to trade. They continue to move goods. They continue to operate supply chains. And those daily operations generate cash, independent of dividends or market valuations. This second layer of earnings is not always visible, but it is what makes trading houses resilient through cycles and crises. And it is likely what caught Warren Buffett's attention. In the next episode, we will open this engine in detail. We will look at how a Japanese trading house combines investment and trading to earn money across an entire value chain. I'm Shosha-man. If this insider perspective helped you better understand how Japanese trading houses really work, please hit the like button and subscribe to join me. Thank you for watching. I'll see you in the next one.